for joining us, David. Can you share with us the role that defined contribution plays in meeting Americans' retirement income needs?
Defined contribution plans have been around a long time, since 1904 in fact, and have provided excellent retirement benefits for generations. We see them today as 401k plans, but you know, the system has been in constant evolution. What we see today is, I think, a future where the retirement income is going to be a combination of Social Security and a defined contribution plan provided by an employer. A few folks will have a defined benefit plan, a traditional pension plan, but except for government workers, that will probably be an exception.
Mm-hmm. So you believe the role of defined contribution in meeting retirement income needs is critical?
It is critical. It is going to be America's supplemental retirement program, if you will, with Social Security. If you look at folks who are saving for retirement, you'll see that they're going to be doing it in an employer-provided defined contribution plan like a 401k.
Mm-hmm. And do you think the plans are working?
I do think that they're working. You know, a defined contribution plan success is based on time and arithmetic. And what we do know is that participants are staying the course. They continue to save and invest in a diversified way over time, even through the most difficult period, like the one we've just had. So what we'll have eventually is people with 30 and 40 years of defined contribution savings, and those folks will be in good shape.
Mm-hmm. And what do you believe is making them work well, and what could make them work better as we go into the future?
What makes them work well, of course, is the fundamentals. It's, you know, saving every paycheck, it's being diversified, it's staying the course, it's just letting compounding work for you. Those are the things that make it work, and that's what we need to do to make sure the system is successful. What makes it work better would be we need to find strategies and new strategies that help people save, you know, adequate amounts, because it is a challenge for young people to save. And you know, but it's still basically what you put in has a lot to do with what you put out. And then we definitely want to have the best reasonable risk-managed investment returns we can get for people, because clearly over a very long period of time, investment returns are very significant.
And what do you think has been one of the greatest advances in defined contribution over the last decade?
I think the change to more employer involvement in the decision making. When the defined contribution plan really started to grow in the 1980s and become a predominant system, it was a build it and you will come kind of system, an elaborate system with tremendous record keeping and great investments and education, but a lot of employees did not maximize the program. And so I think there's been an understanding that if we're going to bring more people to the finish line we want, what we need to do is the employers need to take more of a role. And that means they need to set up systems that get people to save enough and that get them invested in the right way.
Okay. And are we moving in the right direction?
All the data definitely shows that. You see all the statistics, more use of automatic enrollment, more use of escalation in the savings rates, even in non-automatic enrollment environments. You see employers offering turnkey investment solutions, both in automatic enrollment and non-automatic enrollment programs. So it's definitely moving in the right direction.
Okay. And what about target date strategies? Is that good for workers?
Target date strategies are excellent generic solutions. You know, for many employees, they were looking to their employer to make the decision. The employer doesn't have a lot of personal information, but what they do know is they know the age of the employee. And so they can in effect sort of customize a strategy, but in a more generic way. So I think it's a way to enhance the return in the program on a risk-adjusted basis. So I think that and obviously the employers have adopted target date funds with enthusiasm. You know, other than the move to the internet, the move to target date funds is the second most predominant trend that I've seen in over my years in the 401k. I mean, the number of companies adding target date funds in a very short period of time has been really amazing.
And what about the movement toward custom strategies? Does that make sense?
What we'll probably see there is as companies get comfortable with the concept, especially the larger companies, will of course want to use all of the techniques that are available to enhance their program. After all, what's a great way to deliver an employee benefit that doesn't cost the employer anything? You know, enhance your 401k plan returns. So they will clearly be looking to all of the opportunities that, you know, the mass of their assets provide them. And we're already seeing some of that the larger companies are looking to, you know, to customize their programs.
Josh, if you're talking to a plan sponsor about measuring their plan success, what would you suggest to them?
Well, historically, plans have used looked at plan characteristics like how much are my participants saving, how much are they putting away, what do their balances look like. Maybe they'll try to compare that to other plans, but that really doesn't tell you much of anything. It doesn't really tell you what the ultimate goal is, which is how well are participants meeting their retirement income adequacy goals, which is really the ultimate purpose of a DC plan. So we suggest trying to get measures of projecting how well your participants are projected to replace in their retirement years from their income perspective.
So retirement income adequacy, can you talk a little bit more about what retirement income adequacy is?
Well, so it's replacing a certain amount of your pre-retirement income in your retirement years. Let me give you a good example. With simple math, let's say someone's retiring with $100,000 and they need a $100,000 salary, and they need about 85% of that in retirement to maintain their standard of living. So they'll need $80,000 to $85,000 a year. Well, some of that, maybe half of that will come from Social Security, and the other half would need to come from other retirement programs like their defined benefit, or these days it's mostly participants need it from their defined contribution plan.
Sue, thanks for joining us. When you look at defined contribution plans, how has design evolved?
So from an investment structure perspective, we have seen plans change over time. And certainly as other factors have changed with regard to what the objective of a 401k plan should be, we've seen the investment structure evolve as well. So as defined contribution plans have become more important as part of the retirement benefit, we've seen more investment options be created to help facilitate a better investment behavior from participants.
So you've said that the objective of defined contribution plans has changed. How has that changed, or what has the change been?
Well, when we moved from having the majority of folks having a defined benefit plan and having defined contribution act as more of a supplemental plan or a savings plan, to the elimination or the reduction of the benefit provided by defined benefit, that left defined contribution with a heavier role to play as it relates to retirement adequacy. So if we really want participants to be comfortable in retirement and get them there from an investment standpoint, the investment structure for defined contribution also has to change.
So as you looked at plans changing to meet a different objective, a retirement income objective, how has the design changed to meet that?
Well, first and foremost would be the introduction and a heavier focus on target retirement type investments. So really allowing for participants a single investment choice so that they wouldn't have to make investment choices over time, reallocation or a selection of an investment fund. So theoretically, they could invest in one option and get there by their retirement date and successfully fulfill their investment objectives there.
So you've seen this movement in plans focused on retirement income to focus more on target date strategies. So what does a typical defined contribution plan look like today in terms of design?
A typical investment structure from a design standpoint would look like a multi-tiered structure. Most plans do offer some kind of asset allocation fund, whether it be target funds, the majority of our plans do, have some kind of series, or a series of lifestyle funds where you've set to a particular asset allocation. That would be complemented by a series of core options, which would include both active and passive options. And then there could have the potential for a third tier, like an outsourced approach where you could do a mutual fund window or brokerage window.
So Sue, as we look forward, what do you see happening with defined contribution design?
From an investment structure, we'll continue to see an evolution. First and foremost, looking from a plan sponsor perspective, tying the investment structure and complexity to the governance and oversight. A heavier focus on the participant perspective, how they're using the plan, what are the objectives, and how are they investing today, and thinking more holistically on how everything comes together from a retirement readiness perspective.
And does that mean more focus on retirement income outcomes or retirement income solutions and plans as well?
Especially as that ties to the objectives of the plan. If the defined contribution plan is the sole retirement vehicle, the expectation is that not only that we would have the opportunity to think about investment behavior through accumulation, but then through post-retirement income solutions that might make sense for participants over time.
How have DC plans evolved in your opinion?
I think the most important way that they've evolved is that we've learned a lot of lessons from behavioral finance. And the most important lesson we've learned is that the average employee in a 401k plan is really not geared to be an investment expert. And we used to provide them with a lot of tools and education and brochures and lots of investment choice. And we just found that people made mistakes. They did poorly. So behavioral finance taught us a lot of ways of getting around things like inertia and procrastination. That's why we use automatic contribution escalation and automatic enrollment and target date funds. These are the type of things that can help people do well almost in spite of themselves.
So advances in behavioral finance or behavioral techniques, that's been one of the main ways that plans have evolved or changed. When you look forward, Lori, what do you see as what's next? What type of evolution may we see in defined contribution plans next?
Well, what we're seeing and what I've kind of described is the DBization of the DC plan, where we've learned to create a plan that doesn't need a lot of active involvement by employees. And in fact, other lessons from DB plans are coming into the DC world more and more, and I think it's going to affect everything from fees to the investment vehicles that are used, to the way that people use the plan in retirement. And I think that that's going to be a very important evolution, where we've tackled the accumulation phase quite a bit. But in terms of when people are drawing down from their DC plan, there's still a lot that needs to be done to help that phase of retirement.
Lori, as you work with your own clients and you see more going toward custom strategies, what's one of the primary drivers of that direction?
Well, we work with very large plans, and what we find with these larger plans is that they tend to already have a lot of institutional core funds, separate accounts and collective trusts, and institutional share classes of mutual funds. And for them, when they look at the future and see the potential growth of the target date fund in their plan, I think the concern they have is that if they introduce a retail mutual fund as the target date fund, they could end up effectively seeing their plan be rebundled as a more retail-oriented plan, and when they've gone through all this trouble of getting to a very effective cost structure. Now this, this has implications, especially if they have a DB plan. They might also be very interested in seeing their DB managers be part of the target date fund. It's a greater opportunity set. It's something that they're comfortable with. And I think that their mindset is very much open architecture, and they really are focusing on both the funds that are available and also the cost.
So Ross, thanks so much for joining us. Why do plan sponsors like custom target date strategies so much?
You often hear plan sponsors refer to control of all decisions when talking about the attractiveness of custom target date strategies, control of the glide path, control of the inclusion of various investment managers. Plan sponsors spend so much time selecting the investment options that go into the core, it really wouldn't make a lot of sense to include packaged target date funds that don't make use of any of the investments, the best-in-class investments that they've selected as part of the core. Also having the ability to control decisions around asset classes and the ability to include asset classes that are less traditional in nature and they're frequently not included as part of a lot of the packaged products. Sponsors have the ability to control those decisions as well. They have the ability to add global tactical asset allocation, high yield, tips, emerging markets, and these are not hedge funds or private equity. It's a broader series of diversifying asset classes, and again, having control of those decisions can provide the best investment choice for participants.
So in looking at investment flexibility, why do plan sponsors find custom strategies attractive?
Well, I think they find custom strategies attractive for a variety of reasons. The first and foremost being able to diversify among different underlying investment managers, and then I think secondly, but probably even more importantly, being able to develop a glide path with additional asset classes that are a bit more appropriate than what you'd find perhaps off a typical off-the-shelf type of target retirement date fund. The target retirement date funds off-the-shelf version are typically very concentrated into what I call the big four asset classes: cash, investment grade U.S., U.S. equities, and global equities. So among that, all four of those categories right off the bat are four that typically do not do very well in periods of unanticipated inflation. So a lot of the rationale for adding additional asset classes are adding things like commodity futures or inflation protection above and beyond what you find within a typical off-the-shelf glide path.
So as we look at defined contribution plans, we've seen more plans move toward custom strategies. In your opinion, do custom strategies make sense?
For certain plans, it definitely can if they're able to implement it. There's two main reasons why you'd want to do custom strategies. One is because you want control of the underlying investments. You want to be able to pick best-of-breed managers for each asset class. You want to decide what asset classes go into the target date funds. You want to decide your own mix of passive versus active based on your preferences and what you think is right for your plan. The other reason you want to go custom is because maybe your plan demographics have something unique about them that require a different glide path than other target date funds that you can find off the shelf. So for example, maybe it's a defined benefit plan you have, maybe it's something unique about your population, maybe it's your match formula, something about your plan that requires you to have a different slope in your glide path than other plans.
Mm-hmm. And Josh, do you think plans differ demographically at a level where it makes sense to have unique glide paths?
Some plans do, some plans don't. It's probably always good to go through the exercise to see if your plan truly is unique. A lot of times I've gone through the exercise and it turns out most plans are, especially when you're talking about large plan sponsors who have diverse populations, typically a standard glide path probably is good enough for a lot of plans. But certainly we come across plans where they do have something unique about their plan where they require a different glide path.
So why are custom strategies attractive from a communication perspective?
They're attractive from a communication perspective because the message can be tailored directly to that participant. And so whether that's in the graphics that are used or the data that's displayed, the client can really talk about their strategy and the message they're trying to get across in explaining a target date fund to their participants. So in addition to fee and performance and even risk information, the overlying strategy, whether that's in a written format or in a graphical presentation, is all up to customization.
Phil, thanks for joining us. Would you suggest that plan sponsors have an investment policy statement for their plan?
Oh, absolutely. I think the key thing with an investment policy statement is it's a basis of communication with respect to the investment options of the plan, both with respect to management, with respect to plan participants, and also to the extent to your, with respect to your outside vendors. So, we think it's very important that you have an investment policy statement.
For companies that set up custom target strategies, how do they go about putting that within their investment policy statement?
Well, I think the most effective way is to define essentially what your asset allocation strategy or glide path is going to be. with respect to your custom date funds and how that allocation changes over time. The second point then becomes, all right, what are the underlying investment vehicles that are going to be utilized to implement the glide path? And in many cases, it's products that you already use within your plan. And then the third piece really then becomes, all right, what's the ongoing evaluation process, both with respect to kind of a performance perspective as to how your managers are doing, how your glide path is doing, and really defining what's the probability of success at the end of the working career to generate a pool of assets sufficient to support someone in retirement.
So Marla, when people come to you or plan sponsors and they're interested in custom strategies, what are some of the most common legal questions you hear from them?
Sure. A common question that we receive is, will it increase my fiduciary responsibility and my fiduciary risk? That sponsors will think, just because it has the word custom in it and it's not something that's brought to them, doesn't mean that I'm taking on greater responsibility than I would for prepackaged funds. So that's a primary question that we get. In terms of the answer to that question, our view is that the answer is not necessarily the case that you're taking on greater fiduciary responsibility. And if you manage your custom target fund and put it together in a way that represents best practices, we think it can even be a better protection from fiduciary risk and responsibility. For example, consider a fund where you really don't have any information on it, and maybe within it, it's using all the same managers' proprietary funds as compared to a fund that you've put together with best-in-class managers, you've managed fees and expenses, you've eliminated conflicts of interest, and you've controlled the disclosures. I think the answer in that case may be obvious in terms of what's the better fiduciary risk package.
What are the concerns with target date strategies from Washington, D.C.'s perspective?
There's really been three major themes coming out of Washington recently about target date funds. The first one is disclosure. The SEC is asking a lot of questions about whether there is appropriate disclosure for target date funds, and in fact, whether the name target date fund is even appropriate. A second major area is conflict of interest. There's a lot of concern by both the Department of Labor and various people on the Hill that target date funds have too many conflicts of interest inherently built into them, and they're looking at different ways to address those. And the third major theme we're seeing is the issue of relative risk and whether target date funds are too risky. You've heard a lot about this from Senator Cole from Wisconsin, who's questioning the types of investments that are in target date funds and whether they're appropriate, particularly for those target date funds that are near their retirement term.
As you're working with your clients and they're interested in custom strategies, what are the operational approaches that they may want to consider?
Right, well there's really two different operational approaches. The first one is actually creating unitized funds on the record-keeping platform. So really getting a unitized fund, striking an NAV, and building a portfolio that way. The second option is typically a model portfolio approach, where instead of building a unitized fund like your own mutual fund, you actually break out the participant account balances based on target allocations to individual funds. So, for example, if a participant selects the 2020 model, it automatically breaks their account out 20% Fund A, 20% Fund B, et cetera, based on a pre-described glide path. And then semi-annually, in that approach, or quarterly or whatever you choose, we typically go with semi-annually, rebalance them back to targets.
Okay, so there are two approaches. What do you find your clients doing? Do they go one way versus the other?
There's a split. I'd say probably more than half go down the road of the unitization approach. There typically is a bit more complexity and cost associated with the unitization approach, but it does allow for, creating the specific mutual fund allows for specific performance tracking. It also can be a little bit easier to communicate because it shows up like another investment option within the fund or within the menu. Whereas the model portfolio approach, you have to select a model, and it shows up on the participant accounts. Oftentimes, as Fund A, Fund B, Fund C, which adds a little bit, sometimes more of a challenge from a communication standpoint.
And when you look at the two operational approaches, what are the key advantages of going trust versus model portfolio?
The unitization approach has many benefits. I think the biggest one being the communication. The model portfolios, on the other hand, really only have one advantage, and that's usually that they're less expensive from a record-keeping administrative process. So when you're going down on size, I mean, if you're typically $100 million or plus within target retirement date funds, whether you go unitization or model portfolios, the relative cost is relatively similar as a percentage of assets per se. But when you get down into the $50 million range, the $25 million range, suddenly the cost of unitization can be prohibitive in terms of the strategy. So sometimes that's why those plans go with the model approach.
If a client's looking at moving toward custom strategies, what are some of the questions that they should be posing to their provider, their record keeper primarily?
I think the key questions are, have they done it in the past? Have they successfully been able to do it in the past? Because when you get into that record keeping, when you get into that unitization model, you have to manage cash flows coming in, coming out. You have to develop an investment policy, a rebalancing policy. So when cash flows come in, how do they come in? How are they allocated among funds? When cash flows come out, how are they allocated? When do you rebalance? So there's a little bit of that complexity that needs to be built in.
So more and more record keepers are providing these services at a cost-effective level, whether it's model portfolios or trust approach?
Yeah, I think when you get to when you're dealing with record keepers that record keep plans that are in excess of $100 million, I think you're finding virtually everyone doing it, at least in some capacity, whether it's unitization or model portfolios.
So thanks for joining us, Doug. From a participant statement standpoint, is there a difference in what they see if the plan sponsor goes a trust approach versus the model portfolio approach?
It's going to depend on the administrative service provider, but typically when you look at a statement for a model portfolio approach, what you're going to see is, as the plan participant, will be the amount of assets that you have in each underlying fund. So the fund won't say, for example, the ABC Company 2020 target date fund, but instead there may be 5 allocations to 5 of the core funds that are being used. If you look at a statement with the trust unitization approach, you will actually see a fund that is labeled the ABC Company 2020 fund, and you'll have your exact amount there.
Okay, so there's a real difference from a participant statement standpoint.
Yes, there can be.
So trust looks just like a mutual fund, it sounds like, whereas model portfolio, you're showing the individual holdings to the participant.
That's correct. You are seeing each individual holding and not the target date sleeve as a fund with that model portfolio approach.
Thanks, Doug.
You're welcome.
Thank you so much for joining us. So Barb, when you are working with plan sponsors on custom target strategies, what are some of the most common myths they have about communications?
Yeah, that's a really good question, because I think one of the first things we hear is communication is going to be harder because it's a custom target strategy. And I think that's the #1 myth. Now within that, I think there's some concerns employers have. So concern #1 might be, wow, I'm not going to get the support I would get if it was a retail fund. And that's not true. I mean, with a custom target strategy, you can get all the same types of things you do with a retail fund. Take fund fact sheets, for instance. A lot of people are concerned about that. Well, you can create fund fact sheets with the custom target strategy, and the beauty of the custom target is you then point them to the underlying funds, and it's all there. It's actually, in some ways, more complete. Or some employers think their employees want brand name. Well, if I think of custom target strategies or any target date fund, you don't want employees choosing based on the brand name. You want them choosing because what they're looking for is the simplicity and automation that comes with a target date fund. So you really don't want brand name, and in fact, as an employer, if you're focused on the brand name, it actually makes it harder if at some point you need to make that tough decision of I need to change this fund. I think the third type of concern we sometimes hear from employers or plan sponsors is their employees want to look it up in the newspaper. Well, I have to chuckle. That's something we've heard for years with any institutional fund. And the fact of the matter is, I don't think there's any evidence to support that. Most employees are looking for their provider or their plan sponsor to give them that information. And especially as we look at folks that are going to be more attracted to the target date strategies, they're not the ones that are going out and monitoring the newspaper every day.
So Barb, what is the reality in communicating custom target date strategies?
I think when we look at communicating custom target strategies, I actually want to back up and look at target date strategies overall. Because what those did is really make communication much simpler. In the past, we actually needed to educate employees. We had to educate them on investing basics. We had to teach them how to apply the investing basics, and then they had to go implement. There's a lot of points along that path where we lost employees, not wanting to learn, not confident in their ability to make decisions. And because of that, had really bad outcomes for some folks. Like, let me pick the best returns for the last year, or let me put it in the safe choice because I'm not confident. You saw a lot of problems there. So come along target date funds really resolve a lot of that because people can invest, they understand the importance of asset allocation, they can invest and be confident that they've made an okay decision without having to implement all that. Put custom target strategies on top of that, and they actually have much more simplicity. If you think about it, they are simply choosing, do I want to go through a path where the allocation is done for me? Or do I want to do it myself? If you think of another type of option, there's actually more choice that employees should be addressing. Do I want to go the simple approach, which also means I may get different types of investments than I will if I mix my own?
How can plan sponsors make the communication of target date strategies most successful?
Yes, Stacy, I think there's a lot of things plan sponsors can think about. The number one thing is keep it simple. Custom target date funds are actually very complex mechanisms, but the employees they're appealing to want simplicity. So when it comes to communication, simplicity needs to rule. The details need to be there, but don't expect employees to go through the details. Explain it succinctly and easy and make them confident that they can move forward and this is a strategy that's meant for them. It's really helping employees focus on the knowledge they need if they want to do it on their own versus simplicity that they can get if they go the custom route.
So how can plan sponsors make the communication simple so that participants are able to do what's in their best interest?
Right, so I think this starts with when you roll it out. When you roll it out or introduce these funds to employees, it really is that choice of do you want the investment professionals to do it for you or do you want to do it on your own? That's the first decision employees need to make because they get to the same funds either way. So it's a preference. It's a preference based on the time they want to spend as well as the knowledge they have. So what plan sponsors need to do is keep it simple, is keep focused on that choice. Give them the basics so they can understand what it means and what it would mean if they choose to do it on their own. Guide them through the process and let them know more details are there. We have to keep in mind that the type of people who are most likely to go to the custom target strategies are the ones that really appreciate simplicity and may or may not be the ones that want to go through all the details.
When we think of communicating custom strategies, many plan sponsors may think it's far more difficult to provide the details and the facts on custom strategies. What's your opinion?
I think that that is such a misperception in the marketplace that really mutual funds are the only ones that can have the detailed information. Morningstar utilizes all of our relationships with custodians, asset managers, and trustees to collect the information and perform the same analysis on a custom fund as we would for any other registered fund. And we've been doing this for over 10 years for custom investments, and we calculate data on 40,000 custom investments and fuel that to websites and fact sheets for millions of participants. So really, the same level of data is available no matter what the underlying investment is.
So they can get the same type of fund fact sheet, whether it's a mutual fund or a custom target fund?
Absolutely. So the same portfolio risk statistics are available. Even Morningstar measures like the rating or style box are available for private funds and custom target date strategies as well as for mutual funds. And so really we can calculate and present the same data no matter what the investment option.
And then how does a plan sponsor set that up, as well as how do they keep it updated?
We work directly with the sponsor or the provider and their consultant to get the asset allocation information and contact information for the underlying asset managers. And then we collect the underlying constituents for each underlying fund and then aggregate that data to produce a single portfolio for a custom target date fund. And then ongoing, once we've established those relationships, it's we put together a project plan and a calendar that outlines the deadlines and deliverables and milestones for ongoing updates. And once the information is updated in our database and refreshed, then we can recalculate all of the data and send that out into whatever medium the client needs it.
Mm-hmm. And if the plan sponsor is using separately managed accounts, collective investment trusts, mutual funds, are there added complexities?
Not except getting access to the data. So as long as we've got a contact and we know the name of the company, we're able to collect that portfolio information, and we really treat it the same. A portfolio is a portfolio, and we worry less about the legal structure of it when really aggregating and putting together these investments.
So Lori, as plan sponsors are looking at costs, what are the things that they should be considering?
Well, from a cost perspective, I think the key thing that plan sponsors are doing very well today is that they are reviewing their costs. And that's becoming easier and easier as the costs are being made available to them from the record keepers. And we're seeing some progress in that area. But it's more than just understanding costs. It's also benchmarking costs, and benchmarking them in such a way that you're not just using your record keeper's data, but you're using objective benchmarking data. And the importance of that actually has come out recently in a lawsuit that was recently dismissed, where over and over again throughout the lawsuit, it was cited that the benchmarking process had taken place. It was thorough, it was diligent, it was done using independent sources of information, and it was well documented. And for me, that really indicates a good blueprint for ways to fight these types of fee lawsuits that we see periodically coming into the DC environment.
And when you look at costs, what are the components that a plan sponsor should be thinking about or considering?
From a cost perspective, when it comes to evaluating a DC plan, you certainly want to look at the total plan cost. That's very important, and understand that. But it is also important to understand the component costs. And these include things like not only the investment management fee, but administrative fees, which may be actually embedded in the expense ratio of the funds, and of course transaction-based cost. The issue with getting to some of these costs is that they may not even be published in a prospectus, and they may vary record keeper to record keeper. So you really have to drill in and dig in and understand what each of the component pieces are, and I would argue also benchmark the component pieces to make sure that they are reasonable as well.
And when you think of custom strategies, is there an advantage in having a custom strategy to looking at total plan cost?
Absolutely. The custom strategies may be more transparent, and they may be easier to get a handle on because all the pieces are already disaggregated. You're not trying to investigate where the costs are because you, as the plan sponsor, have built the strategies and understood the costs as you built them.
What about a plan sponsor using collective investment trusts or separately managed accounts? Does that make sense for them to use structures other than mutual funds as they build their plans?
Again, from a large plan sponsor perspective, it absolutely makes a ton of sense to use the institutional structures like collective trusts, separate accounts, and of course institutional share classes and mutual funds. And again, if we look at the fee lawsuits out there, some of them really have centered on the use of these institutional structures in large plans where it can be very cost effective. I think one thing plan sponsors should certainly do is to document that they've reviewed at least document that they've reviewed the use of these types of structures and document why they haven't used them if they indeed find that they don't want to have them in their plans. But it can, again, be very cost effective, and for plan sponsors of plans $1 billion and above in assets, you can find real cost savings with some of these structures.
Do custom strategies make sense from a total plan cost perspective?
They can. You know, again, if you're looking at a larger plan, and you've looked, and in many cases, the larger plan has already built a very institutional structure with separate accounts and collective trusts and institutional share classes of mutual funds. That is a structure that I think really you need to examine the possibility of a custom target date fund because of the cost and the open architecture impact of it as well.
You know, if you were working with a plan sponsor and you wanted to help them bring their costs down to the lowest possible level, what would you suggest to them?
Well, I would suggest that they start from the point of view of saying, you know, what funds do we already have in our lineup, and do we have the most cost-effective structures for each of the core funds? And then from there, look at the possibility of the custom target date fund. Obviously, it doesn't make as much sense to have a custom target date fund if you have a bunch of retail mutual funds in your core structure. I think the other thing you want to make sure you look at as a plan sponsor is to see how well your record keeper is equipped to handle a custom target date fund, because that can add cost, and you want to make sure that in the aggregate it's going to be cost effective, even though you have these fabulously inexpensive structures within the plan and within the plan's core funds. You also want to make sure that in building the custom target date fund, you don't introduce costs through the record keeping setup costs and so forth.
And what if that client has the defined benefit plan?
And if the client has a defined benefit plan, you know, certainly that's an environment in which they're probably very familiar with the institutional structure, with having a custodian and that's unbundled from their record keeper, and they're probably comfortable in that environment. And I would say that those types of plan sponsors should certainly be thinking about custom target date funds.
What standard does the Department of Labor hold plan sponsors to relative to managing their plan cost?
ERISA requires that a plan's fees and expenses and costs be reasonable. So towards this end, fiduciaries have a responsibility to engage in a prudent process, and process is very important under ERISA, a prudent process to determine that the fees the plan is paying are reasonable. Another key component of this process is transparency. For a fiduciary to prudently determine that fees are reasonable, they have to be able to understand what the fees are. So that's a reason why custom strategies can actually offer a fiduciary advantage, because it puts the plan sponsor in the driver's seat and it makes it possible for funds to be more transparent.
There's been a lot of discussion about glide paths, particularly as people are approaching retirement and entering retirement, and how aggressive or conservative the glide path should be. What's your opinion?
We would tend to believe that you should be more on the conservative side relative to what we're seeing as the average target date funds out there. You know, you're at the most risk the day you retire. So we think this is the area where you need to start conserving risk and preserving the savings that you've built up. You know, you've had a lifetime of savings going into retirement, and you have the longest amount of time where you need to fund your retirement. So this is a time where there's a lot of point-in-time risk, and as we saw in 2008, retirees are very vulnerable at this period. So that we would suggest that you become much more conservative as you enter into the retirement years.
And when we look at glide paths, there's been a discussion of the to versus through, and the definition of to really varies. So what is your definition? Would you say it's a certain percent allocation to equity?
Well, I think the way the marketplace is defining it is they are saying the to funds are ones that go to retirement and flatline their glide path, and they don't continue to change their asset allocation in retirement, where the through funds continue to change their asset allocation in retirement. I think this to versus through has been, the debate has misnamed and mischaracterized a lot of the strategies, because I think for too long the to funds are labeled as not caring about the retirement years. Like maybe there's an assumption that the to managers think that the individual is going to just take their money out of the plan, and that's why we don't continue to manage their assets in retirement. But we don't think that's true. We think to managers still care very much and understand that participants probably are going to remain in their fund, and they care very much about what that right asset allocation is in retirement. To managers just believe that it should be more conservative and that it should be flat. there's actually not much of a investment rationale for continuing to slope down in the retirement years. We believe actually a flat glide path makes more sense from an investment standpoint, and we think that asset allocation should be more on the conservative side, something between 30 and 40% in equities.
So Mike, thanks for joining us. When you are working with clients and thinking about developing a glide path, what are the different considerations, or how would you even go about constructing a glide path?
Well, to me, the most important thing in constructing a glide path is understanding the constituents of the participants themselves. What are their characteristics? What things set them apart? What things make that company different? Are their savings rate higher or lower? Do they have different characteristics within different ages? Is there a pension available for a certain set of constituents and not for another? And then the glide path should be built in order to accommodate all of those different characteristics.
And when you think of one organization to the next, how different might a glide path be based on their demographics?
Well, I think it could be quite different depending upon the age of the company, the age of the average participant in each age group, each age cohort. Companies with sort of a lot of legacy employees with pensions for the 45, 55, 65-year-olds are going to be very different. Something, say, a utility, a bank where there's a lot of lifetime employees, as opposed to something like a high-tech company where the turnover's higher, the tenure's shorter. And each of those things is going to have very different sets of metrics in terms of how the glide path should be constructed.
You've said that the demographics can really change the way that the glide path is structured. How different might the glide path be as a participant approaches retirement?
Well, let's take sort of two examples of glide paths that would be quite different. Again, you take sort of the high-tech company, companies with participants who tend to have higher turnover, less tenure, not been there 20, 30, 40 years. And I think their glide path is going to look a lot more like maybe what everyone thinks of as an average. So it's going to tend down to maybe that 40% equity at retirement sort of range, at least the range that I would personally prefer to see. And then on the other hand, you take somebody, an old line manufacturing company, maybe some banks. People are companies where there's been a good deal of participants who have a long tenure. 20, 30 years, and they have a pension, and the pension is the key characteristic and the key differentiator. In those cases where you've got particularly the older cohort, the 45, 55, 60-year-olds who are looking to retire, the equity allocation, they can afford to have a much higher equity allocation in those characteristics or under those characteristics than the high-tech company, because the pension cares for the bulk of the investor's needs when they retire. The 401k plan is, you can think of it as a supplemental savings plan, and they can afford to take a great deal more risk within that because their ability to fund spending when they retire is covered elsewhere.
Okay. And there's been quite a bit of discussion recently about to versus through, whether we're managing a glide path to a retirement date, for instance, 65 years of age, versus through all the way perhaps to mortality date. What's your philosophy?
Well, I'm adamantly in the to camp. The through camp gets into ranges and characteristics that I don't believe the average target date fund can accommodate. The target date funds are designed to be generally a one-size-fits-all for a cohort. When you hit retirement, the number and complications of issues that an investor must deal with are just too great for the average target date fund to accommodate. You need to understand things like health issues. Are you healthy or not? Family history, long-lived, short-lived. Issues around how well have you saved for your retirement, how poorly have you saved for your retirement. Do you want to leave money behind? Don't you want to leave money behind? And all those things come into play in generating an appropriate solution for retirement. And again, I'm just adamantly in the to camp, not the through camp.
And when we think of the assets going into the glide path to create an optimal glide path, what are the assets that must be there in your opinion?
The asset classes that must be in a glide path? The asset classes, should be obviously the the standards: U.S. stocks, U.S. bonds, cash, to a limited extent on the cash, and then I think there's absolutely must have international stocks. And then today, given the investment options that are available, there should be no real excuse for not having things like real estate, tips, commodities, other diversifiers that, while they may not have been the best diversifier in the last 12 to 18 months, are long-term likely to be good diversifiers in the future.
So Ross, when you look at overall plan design for investments, what do you typically see these days? What makes sense?
Most plans make use of a multi-tier construct. Historically speaking, or at least in the last several years anyway, most sponsors have talked about a 3-tier design that would include a series of target date funds, a series of core options, and potentially a brokerage window.
So in helping plan sponsors set up custom strategies, they're typically going to tap into the core options. What core lineup does the plan sponsor need to be able to achieve optimal strategies?
Plan sponsors really need what has traditionally been a series of core building blocks for a few reasons. And so you can create portfolios with varying degrees of risk using a handful of asset classes, a cash vehicle, a fixed income solution, large cap equity, small cap equity, international equity. And within each of those core building blocks, you have the ability to give managers looser constraints that allow them to add additional diversifiers. In the fixed income space, you can have emerging market debt, global bonds, high yield, tips. In international equity, you can have emerging market equity and small cap international equity. And so sponsors really can begin with a more reasonable set of core options. In addition to those, there are asset classes that a sponsor can include with custom strategies that they would not necessarily offer as part of the core. Those would include things like global tactical asset allocation and absolute return strategies.
When you look at defined contribution plans today, what asset classes are typically missing that you would encourage plan sponsors to add, especially as they're designing custom strategies?
Plan sponsors today are really looking at a much broader list of investment opportunities than they have historically. And so they're looking at things like global bond strategies that make use of emerging market debt, global bonds, high yield, tips. They're looking at things like global tactical asset allocation strategies. Historically, sponsors have been a little bit reluctant to include some of these strategies and asset classes because participants are not professional investors. And so the conventional wisdom has been offering these options in isolation or as standalone options is potentially risky. On the pension side, sponsors have been more likely to include them because you have a more informed group of trustees or committee members making decisions. On a go-forward basis, particularly in custom constructs of diversified vehicles like custom target date funds, you now have the ability to really include a lot of these diversifiers in a very effective way. You also have the ability to include diversifying asset classes as part of the core options to the extent that you give managers, you take the handcuffs off and you give them more leeway and fewer constraints.
Bottom line, as we look at custom strategies and bringing in alternatives or less liquid securities, what are you seeing?
Well, so a couple things. We've seen several plan sponsors that have gone ahead and made use of liquid strategies. The current environment that we're in, the liquidity crisis of 2008, has certainly made people a little cautious with regard to approaches that make use of liquid securities because when the market is falling, there's greater need for liquidity. And even with some of the traditional vehicles like index funds, for example, that make use of securities lending. When index funds were suddenly illiquid, it made it very difficult for a lot of strategies to be rebalanced and so forth. Having said that, there is a continued evolution on the target date front, and so you will likely see more sponsors making use of direct investment in real estate, for example, and other illiquid approaches. And then in addition to that, you have the evolution of the daily valued products as well. There are, again, using real estate as an example, there are several products out there that are daily valued that make direct investment in real estate. And again, the key there is just that there has to be a liquid portion of the fund to handle the daily flows and the daily valuation. There's nothing inherently wrong with offering assets that are not daily valued. The plan description just has to outline the nature of the assets and how they're valued, how frequently, and so forth.
Kevin, thank you for joining us. When plan sponsors think about capital preservation for their plan, what would you suggest they think about?
Well, a well-structured defined contribution plan should maintain a capital preservation investment alternative. There's largely two alternatives in this space. One is a money market fund, and the second is a stable value option. And we generally prefer a stable value investment alternative to the extent that a fiduciary has regular meetings and can review all the appropriate fiduciary data points on a routine basis. And the key reason for that is because you get 100 to 150 basis points of return premium relative to a money market fund in a stable value alternative with limited amount of credit risk and interest rate risk that can be well managed and thought through at a fiduciary committee level.
And have the considerations around stable value changed since we've seen the insurance companies and wraps and issues in the marketplace?
Yeah, it has changed a little bit, but at the end of the day, the dynamics of a stable value investment alternative remains as compelling as today as it was 24 months ago before we entered into the credit crisis and the deleveraging cycle that we just experienced. There's less capacity for wrap providers, which is a concern. But at the end of the day, we continue to see that fiduciaries with a separate account or commingled vehicles in a stable value environment have come through this cycle very successfully, and now are continuing to generate returns that are delivering on the promise of a 1 or 1.5 percentage points over a money market fund.
So do you believe stable value continues to make sense for defined contribution plans?
Yes, absolutely. Stable value remains a very compelling investment alternative. Largely because of the return premium you receive over a money market fund and the fact that the capacity for the wrap providers, while constrained at this moment, remains still available. And at the end of the day, the fixed income credits that underlie the stable value option have come back very strongly. And the crediting rates, the rates of return that participants are receiving are extremely attractive relative to money market funds.
And Kevin, there's been more talk about unwrapping stable value. So it's in essence a fixed income fund. What's your view of unwrapping stable value and offering, for instance, just a short-term bond fund?
Yeah, you can do that as well. The significant downside is the fact that the stability of the principal will not be there to the extent that there's any significant change in the short-term fixed income portfolio from a pricing perspective. The participant will feel that. So if they put $1,000 into an unwrapped stable value fund, they may have $989 at the end of the next quarter to the extent there's an adverse credit event underlying the portfolio. So we would continue to prefer to keep that safety of principal as a key metric for a stable value option. And to the extent that you need to have a diversifying investment alternative relative to stable value and a fiduciary believes that's appropriate, short-term fixed income does have some appeal, especially in the face of rapidly rising rates. It may be a very good place for participants to place short-term capital to avoid capital losses, because we all know when interest rates rise and we can see significant declines in pricing of bond portfolios.
Kevin, let's talk a little bit about custom target strategies.
Oh,
Does it make sense to have stable value within a custom strategy?
Yeah, there's some significant merits if if you load up a stable value investment alternative into an optimizer, the principal, the safety of principal, and the return patterns that stable value generates is the optimizer likes it because it produces a more efficient portfolio from the perspective that you get this unique accounting privilege of book value accounting that basically flattens out all the significant levels of potential returns that are both negative or positive in a short-term bond portfolio.
So you like adding stable value into custom strategies?
We would find that attractive, yes.
So Matt, as we look at plan participants and the risks that they face as they're saving toward retirement, what are some of the risks that they should be concerned about?
Well, there's all sorts of risks. The market risk is probably the one that coming off of 2008 is the one that's in the front of the minds of a lot of folks. I mean, I think the typical 2010 target retirement date fund lost 25%. And again, these are people that are supposed to be retiring in a year or 2 years after that period. So I think market risk is on the minds of a lot of folks right now, and just how aggressive target retirement date funds should be as you approach your target retirement date. You can control that through the old-fashioned equity versus fixed allocation, or you can also control it through broadening diversification to other asset classes that are perhaps less frequently used within glide paths.
Okay. And what are some of those additional asset classes? How can you bring volatility down for participants?
I think one of the huge advantages of a custom target retirement date fund glide path is that you can incorporate stable value as an asset class. In off-the-shelf mutual funds, if you're looking at that cash type short duration fixed income allocation, it's you're typically stuck in a money market type of vehicle, but in a target retirement date fund you can incorporate stable value, which has a nice little gimmick that allows you to get a short to intermediate duration bond fund type of return with very low volatility or no volatility theoretically. So having that ability to incorporate cash or incorporate that stable value instead of a money market type of vehicle or bond fund within the target date fund can help mitigate some volatility and give you a little bit of a free lunch within a glide path. But some of the additional asset classes that we really emphasize, TIPS, Treasury Inflation Protected Securities, they're one of the few assets that you would expect, at least over a holding period, if you have unanticipated inflation, give you a fighting chance to keep up with inflation. Other asset classes like commodity futures might be an asset class you're not comfortable offering a commodity fund in the core lineup, but within a 5 to 10% type of allocation within a target retirement date fund can really help protect against unanticipated inflation. Certain other asset classes like real estate investment trusts, or even we've even had clients use a very unusual asset class called MLPs, Master Limited Partnerships, which are energy pipeline type of funds that you can use that actually provide a very nice inflation hedge as well.
Okay, so very broad asset diversification can bring volatility down. You also talked a little bit about the glide path and making it more conservative potentially as you approach retirement. We know that there's been a real discussion in Washington on the to versus through. What's your philosophy?
Well, that's a huge challenge because in an ideal world, participants would start at age 21 at a company, stay there for 44 years, retire at age 65, and then leave their money in the 401k plan until they're 85, and they would just take a withdrawal right out. And then you could easily just say, well, obviously it should be through retirement. And then you would build a glide path that gets more and more conservative as you enter retirement and go through retirement. The reality, though, is when you look at the typical 401k plan, and it varies significantly from plan sponsor to plan sponsor, but a lot of participants, when they retire, they roll their money out of the plan. So this idea of building a glide path with the assumption that it's through retirement all the way to 85, 90, and death, ultimately. Mortality.
Yeah. Okay.
The idea of building a glide path all the way for that, I think, is a little unrealistic. So there, in my opinion, there needs to be almost a blending of the objectives. One is that you can provide, based on the current framework we have now for target retirement date funds, there needs to be this idea that for participants that do leave their money there, it provides them a through return stream, but there has to be that expectation that a lot of those assets are going to flow out, which would argue for potentially even a little bit more a conservative approach. As we go along and certain additional innovations come into the marketplace, whether it's guaranteed minimum withdrawal products or annuities within retirement 401k plans or defined contribution plans, then some of that problem might eventually go away. But right now it is a big challenge.
And so you would argue that as the glide path approaches retirement date, a person may be 65 years of age, that it should be generally more conservative than some that are out there? What might that look like in terms of equity to fixed type mix?
Well, I think part of it has to do with if you're looking at your plan, if you're looking at a specific plan sponsor, you have to know certain things about the plan sponsor. Number one, what is the typical savings rate for participants within that plan? How long do they stay there? What's the demographic? Is there a defined benefit plan? What kind of company is it? Is it a more sophisticated group with sizable asset balances, or is it a group where this is, maybe their core retirement nest egg is the defined contribution plan? So there are some of those factors that you have to consider when building the custom glide path. But I think on average, the typical target retirement date fund is far too aggressive. When we build our custom glide paths, we actually built in a constraint in our 65th, or when a participant hits 65, hits their retirement day, we want the so-called 100-year flood scenario to be a 10% loss, no greater than a 10% loss. And we're not talking normal distribution 100-year flood scenarios, we're talking the true tail events. Because at the end of the day, if a participant's 65 years of age and they have 25, 30 years of retirement ahead of them, you might say they should have a significant amount in equities still in retirement, but if they lose 25% the year before they're supposed to retire, you have to worry about the behavioral finance kickback on that, which is pulling the plug and moving their money into a stable value fund or something like that.
And with your approach to risk management, where might you stop the equity allocation then for a 65-year-old?
I think we have clients that typically range between 25% equity and 40% equity, right around that magic date of retirement date. Again, that could go up to 50 for some glide paths where we incorporate additional asset classes like high yield bonds and emerging markets. And the broader diversification we can get within the portfolios, typically the greater equity allocation is still there at retirement. And I think that's one of the things that's a bit different than the way we design glide paths, is they tend to be a bit more barbelled. So even our retired portfolios will have emerging markets, they'll have things like MLPs, even our conservative mixes, but they might have a significantly higher allocation to tips to kind of compensate for that.
Chris, thanks so much for joining us. So as you think about plan participants and saving for retirement, what are some of the primary risks that they should be worried about?
We see primarily 4 risks that participants face as they prepare for and enter into retirement. First is the timing of their retirement, and then the second is the volatility of the markets, primarily in the 5 years before and the 5 years after they enter retirement, which we would call the transition phase. A third risk that they face, we see, is inflation risk. So the risk that inflation will erode the purchasing power of their retirement income. And then finally, the fourth risk is really the element of longevity. The likelihood that they'll live longer than they either expected to or longer than their accumulated assets will allow them to sustain retirement income.
When you think about helping participants protect against those various risks, what would you suggest?
As we think about how to mitigate those risks on participant outcomes, I think we would look at it from 2 perspectives. One is plan sponsors could look at incorporating an insurance option or an insurance vehicle is an option in the plan. The second is they could investigate alternative strategies to help mitigate those risks. The first, from the insurance perspective, there are several options available in the market today that allow participants and the plan sponsors to mitigate, in particular, the transition risks and the longevity risks associated with retirement. There are many investment options, oriented options that are specifically designed to mitigate inflation risk in particular, and to a certain extent some of the transition risks that we talked about earlier as well. So those are at least two perspectives that they should be thinking about.
Okay. And Chris, in working with plan sponsors, what are some of the most common risk protection approaches that are being taken today?
With respect to what actions plan sponsors are taking today, I think we would see primarily two. The first is custom target date strategies that incorporate alternative asset classes, whether they be real asset classes or TIPS or some other types of vehicles that are designed specifically around real returns or inflation protection of some kind. The second element that we see being taken up in the market today are the insured vehicles that are primarily variable annuity-like with the guaranteed lifetime withdrawal benefit wrappers around them. So of the insured vehicles, the GLWBs, as they're called, tend to be the ones that we see the most acceptance around today.
And you are seeing those types of insurance products come in to plans for accumulation, is that right?
During the accumulation phase, we do see adoption of the insurance-oriented vehicles because of the effect they have in terms of helping with the transition risk. So the volatility of the returns in the market immediately before retirement and immediately during retirement, the transition years. And then with respect to the income options, they're obviously going to provide some longevity protection that you may or may not have with the insured, with the investment-only vehicles.
So Mike, let's talk about benchmarking. Can custom target date strategies be benchmarked?
Yes, they can be benchmarked, but the benchmarks should be custom, like the strategy. I don't believe there's one size fits all in the custom benchmark arena, or in the benchmark arena as a whole. The whole idea of benchmarking to averages, I think, is inappropriate, particularly in the custom world, because the whole idea behind the custom is that it's custom. It's yours. It tailors to your characteristics and the participants in your plan's characteristics, and should be measured against something appropriate to that.
Let's talk about what is appropriate. If you were to help a company benchmark custom target strategies, where would they begin? What should they absolutely do?
Well, I think the first place to begin is, ultimately the power behind any target date fund is the investment options. Who are the asset managers hired to implement each of those asset classes? And it looks no different than benchmarking a pension fund. Who have you hired? What have you hired them for? What is their benchmark for the particular slice of the target date fund that they're supposed to implement? And how well have they done against that? Once you've accomplished that component, then there's the whole idea of, is the glide path correct? And that's the harder thing to benchmark, because there's no good way to say this is the right benchmark and that's the wrong benchmark, or you should have more equity or less equity, or more bonds or less bonds, or more tips or less tips, or more international or less international. I think you have to have as a custom target date follower, you really have to have the belief that your methodology for establishing the risk level for any given place along the target date line, glide path, is appropriate. So it's really more of a belief on the glide path that you've got it appropriate, and not so much one of hitting the right spot that someone else has designated.
Do you see any benchmarking approaches developing in the marketplace today that are particularly helpful?
Yes, my favorite way of benchmarking a target date fund is to actually examine the participant as an individual, their allocation to the target date fund, their savings rate in terms of how much they're saving and putting away today, and actually doing a calculation to say, with a given probability, how likely are they to be able to replace some percentage of their income at retirement. So it's really truly has the target date fund lifted the boat of each individual participant in terms of retirement readiness. That's my favorite benchmark, because I mean that's really what a target date fund, what any retirement fund is supposed to be able to do, is help the investor get to retirement with enough money to fund their retirement income desire. And that's, there are a lot of technologies out there now that are beginning to accomplish that.
And that, if you're looking at whether a target date strategy may help the participant meet their goals, that's prospective. It's not looking in the rearview mirror.
No.
And how do you get that right? Because there are so many assumptions that a plan sponsor would need to make, or their consultant.
There are a number of assumptions that you have to make within doing the sort of prospective approach to benchmarking. The biggest ones, frankly, are the capital market assumptions. What do you think are the distributions of the various asset classes in your target date portfolios? But again, you're making those assumptions, the asset managers are making those assumptions every day. They're making them to run the portfolios. The plan sponsor's making them when they're buying the investment products and managing them through time. So it's not like those things are uncommon. You don't have to go out of your way to find them. Once you've done that, though, the calculations are, while they may be daunting in terms of the numbers of calculations that need to be done, how many simulations do you run, what sort of distribution do you use to draw from, what sort of tax rates do you assume, what sort of inflation rate do you assume. But the other calculations are relatively straightforward. How much are they earning today? What sort of replacement of that income would you like to assume? What's their current asset allocation or the target date fund's allocation? If it's a custom fund, you know the glide path, so you can bake that into your prospective illustrations. So, while they are daunting in terms of the numbers of calculations that need to be done, I don't believe that people are doing anything more within those prospective calculations than they're doing today in managing their portfolios.
So Phil, in helping plan sponsors benchmark custom strategies, what would you suggest to them?
I think the first thing is really to define the glide path that you're looking at. And as we look at custom structures, the important thing is understanding the structure. If you understand the structure, you then are going to have an understanding of what the resulting performance is. So you define the glide path, which essentially gives you your structure, how aggressive you are, kind of what is the allocation as participants approach retirement, kind of what's the allocation as people move past retirement. I think that's a significant point of differentiation among various products. The second thing then is, again, defining the investment roles utilized to implement the glide path, and defining the managers that you utilize to implement those roles. The evaluation part of it really comes down to a couple of things. What's the level of risk that your allocation strategy provides over time, and what's your comfort level with that level of risk? The second point is you're interested in the performance of your underlying managers, as you would be in any other investment structure. And then the third part is a little bit more of a challenge, because it's evaluating what's the probability that this structure is going to result in a meaningful benefit at retirement for a participant. And what's the ability that you're going to have a sufficient block of assets to provide an income stream while in retirement. So those are the three things I would focus on.
If you're going to help look at the retirement income adequacy coming out of a glide path, how do you go about doing that?
Well, that's a little bit of a challenge. Essentially what we do is run various stochastic simulations as to what our expectation is with respect to investment performance over time. This is also based on capital outlooks that we have. And essentially what we're looking at is this stochastic modeling is the expected return, basically the 50th percentile, as to what is there a 50% or better probability that this is going to generate a meaningful benefit. The other thing that we look to it as well, and I think this is important, everybody assumes everything goes right. And when you look at modeling or evaluations of modeling, it's also important to get an understanding of, yes, it's nice to know what happens if everything goes right, but also you need to have an understanding of what the downside risk is, if everything does not go right. So as we look at things, we kind of establish a range. We have the expected outcome, but we pay a lot of attention to, okay, what's the downside risk associated with this?
So Lori, what are some of the best ways that people can go about benchmarking, particularly custom target date strategies?
Well, we did a survey recently and found that the most common way benchmarking is done is just to use the passive mix of the investment manager's index. So to use the index provided by the investment manager. And that certainly can help you understand the active manager value added of the custom target date fund or whatever target date fund you're evaluating. But unfortunately, that really only gets to a part of the overall performance, because the thing that really is going to influence performance quite a bit, obviously, is the glide path. And there's a lot of indices out there now that allow you to benchmark the glide path as well. So there are objective benchmarks that allow you to understand, whether the glide path you have is in line with others, is more aggressive, and in what ways more aggressive and conservative. I think that's important because as a plan sponsor, you want to feel that you understand the, where the risk is within your glide path, and where, and the extent to which there's the downside risk, especially for those close to retirement.
And Lori, if you're working with one of your clients and they're interested in benchmarking, what would you suggest to them?
I would suggest that they break out the benchmarking into component parts, so understand what's driving performance both from the perspective of the manager value added, active management both from the point of view of alpha, but also from rebalancing and straying from the target, but also understanding the extent to which the glide path is driving performance, and are they comfortable as a plan sponsor with the way that the glide path is driving performance. There should be no surprises, and a lot of times how these custom target date funds, in fact any type of target date funds are chosen is based and developed is based on projecting out what the likely outcomes will be in the long term, and further what the likely outcomes might be in downside scenarios like we saw in 2008. So the glide path results, the actual glide path results, should fit into that context. And if they're surprising relative to what you thought you were picking, then that should be a red flag.
And with custom strategies, is there a particular type of benchmarking that you would suggest? And is there a particular advantage to custom strategies when it comes to benchmarking?
I think a key advantage to having a custom target date fund when it comes to benchmarking is the fact that there's steps you can take to change the glide path if in fact you find out through benchmarking that you're uncomfortable with aspects of the glide path. The analysis of the glide path when it is a target date mutual fund can only lead you to one outcome if you're unhappy with the glide path, which is to get another target date mutual fund in your plan. But when you have a custom target date fund, you can actually take action and work to address any issues you find in your glide path analysis.
Now, does that hold for the underlying managers as well?
Yeah, certainly within the open architecture type of an environment you have with a custom target date fund, if you find that through the active management of certain of your underlying investment managers that they're not achieving the goals that they set out to, you've got the flexibility to replace them. And that's another way that a custom target date fund differs pretty substantially from a target date mutual fund, where again your only recourse if you're unhappy with the underlying manager's performance is to fire the whole target date series and replace it.
If you were to work with a company on benchmarking their strategies, what do you believe is the most important thing for them to do?
Well, the most important thing for them to do is to think of the fund family as a whole and not just look at trying to compare each individual sleeve of the target date fund versus other sleeves, because that doesn't really give you an answer. Let's say your benchmarking approach tells you that the 2050 fund, your 2050 fund is doing well versus others, and your 2010 fund isn't doing well. Well, that doesn't really help you much, because you're not going to pick the 2050 fund from one fund family and the 2010 fund from another fund family. We'd recommend that plan sponsors take more of a cash-weighted approach to evaluating how well their target date funds are doing in building retirement income wealth. So it's looking at historical performance of the target date fund family as a whole and seeing how well that fund family has done in building retirement income adequacy.
Josh, in working with clients on custom target strategies, how would you go about benchmarking those?
Well, custom strategy can be benchmarked the exact same way as any other strategy. You're still looking at, if it's looking at historical performance measures, you're still going to have that same performance track record. If you're looking at forward-looking measures, again, you can use the same kind of methodologies you would do for a mutual fund. So I don't really see much difference between a custom strategy and a mutual fund in evaluating target date fund performance.
Are there some advantages with custom strategies when it comes to benchmarking?
Well, when you do your evaluation process, if you don't like how the results of your custom strategies are coming out versus a mutual fund, there's something you can do about it. When you have a custom strategy, you can change asset classes, you can adjust the glide path, you can put different managers in. When you have a mutual fund that you're buying off the shelf, you don't have control of the underlying strategy and asset classes.
In terms of benchmarking and sharing benchmarking information with participants, what approach might make sense?
At Morningstar, we recommend a couple of different benchmarking options. Certainly an industry index, whether it's a single index, or we work with a consultant and a plan sponsor to create a blended benchmark of multiple underlying investments by asset class. Category comparisons, so using the distinct category or group of peers for that particular time period of the target date, and then showing the actual versus the target allocation, and again, that's just the asset allocation weighting.
So many plan sponsors ask, with target date strategies or even with managed accounts, do participants even need education at this point?
Absolutely. Not only from an education standpoint to help them understand what they have, but also it is the opportunity from a plan sponsor perspective to make them appreciate the benefits that they have in the plan. In 2008, we saw a lot of surprises with regard to target fund structures, the investment allocations, and that with just simple education and communication, participants could have been more informed about the investments that were made on their behalf, especially in default scenarios.
So we know within target date strategies, or if they have managed accounts, participants are receiving asset allocation advice. In essence, the question of how should I invest my money is being answered. So what other type of help do participants need at this point, since they have those types of vehicles?
So from an education and communication standpoint, it's helpful to remind participants what they're invested in and what the ramifications are in different market environments, as well as what that means at the end of the day from a retirement perspective. So in having the opportunity to continue to touch your participants in different ways, either it be through web design or websites or written education and communication, there's an opportunity to again reinforce the messages that are put forward and help participants understand what they have. And I think, going forward, that would be an opportunity for folks to also reiterate the benefits that they have in the plan.
Mm-hmm. And do you think it's important to help participants reframe their defined contribution plan into retirement income? In other words, instead of showing them a balance, show them what that may mean in terms of monthly income in retirement?
Absolutely. Because folks aren't thinking about, participants don't think about their investments in that way. But the reality is they need to understand how they can use that investment pool and those investments going forward into retirement. So by putting it into terms that they can relate to on a monthly basis, relative to their expenses, relative to how they want to live their lives, it could make it a lot more real in terms of the information that's available to them.
Okay. And what about saving more? Do participants need to save more, and how can we help them achieve that?
Absolutely. Participants are never going to make it as they are investing today. And the reality is we need to encourage them not only through good investment structures, but also through plan design that will help them get into the plan, maximize their savings, maximize the match and the benefits that they have from a plan design perspective, and then help educate and communicate with them as they go through that investment cycle, as they go through the time between now and retirement.
So Sue, do you think it makes sense for participants to stay in the plan at retirement?
I do. And everything that we're doing from an investment standpoint and a design standpoint today helps to encourage that kind of behavior. It not only benefits the total plan, but it benefits the participants who are at retirement. And many of the structures, like the target funds, the income solutions, they're all designed to keep people in the plans post-retirement.
Financial planning is a tough term to define. Different people look at it in different ways. In my view, financial planning isn't a product that you can go buy on a stock exchange. It's a process. It encompasses everything that you do financially, both from investments, insurance, savings, retirement. It's looking at the whole picture, not just one small piece of what you're trying to accomplish.
Do participants really need financial planning?
I think they do. I believe those target date strategies allow them to invest more easily without being overwhelmed with choices. So it allows them easy entry in terms of saving for their future. But that's just one element. If all they're doing is just focusing on their retirement, they may be missing other things like college planning for their kids or budgeting, things like that. So it doesn't replace the financial planning process. Again, it's just one side of it. But more importantly, it just helps them start towards their retirement goals.
How can companies help their participants as they're looking toward retirement and saving for those goals?
Communication is very important. There's a lot of communication that I think participants get. Sometimes participants don't want to receive that necessarily, or it may not be in the way that they're ready to receive it. Multi-language approaches I think are very good. Just trying to figure out a way, how do we get that participant to really look at their future and start saving for it?
So Ed, in your opinion, can retirement planning stand on its own, or does it need to be part of a broader plan?
If you just focus on one element of, let's say, this broader plan, you just focus on retirement planning, one of the things that you may lack is balance between all that you're trying to accomplish. For instance, if you're trying to save money for your kids' college, you may be putting too much in your retirement plan and not enough in college planning. If you're not looking at how much you're spending, you may not be able to save for either. So you have to look at one element of it, retirement planning, in the broad scheme of everything you do in terms of financial planning.
Ed, what is it that plan sponsors can do to provide broader support around financial planning for their participants?
There's a lot of different channels, I believe. If you look at how corporations reach out to individuals, whether it's through web-based advice or through literature or one-on-one planning even from a professional that's hired by the firm. These are all elements that these individuals, corporations can do to reach the individuals in their plans.
From your perspective, why do you think financial planning is so important?
Being in America, it's the land of opportunity. So with that, it's just that opportunity. You have to make the best and the most of what you have and what you do. So people receive a paycheck, but they have a lot of choices in terms of what to do with that paycheck. The pie is only so big. So if you're saving for retirement, if you're saving again for college, there's a balance between that. And you have to be very careful in terms of how you approach financial planning in regards to that whole element.
What are the retirement income solutions that are either being considered or added to plans today?
We see a lot of different things happening in this area, and it's all in response to risks that participants are now realizing they have in retirement. So on the one hand, just allowing greater flexibility in the withdrawal options from the plan, that can be a huge help for employees. They can keep their money in the plan after they retire and have more flexibility of how they draw it out. But beyond that, annuities can be a really important strategy for many people as they retire in terms of helping them protect against that longevity risk. So annuities, both the immediate and deferred annuities, and both of those could be in the plan or facilitating to outside the plan getting to annuities. Again, we think we'll see more employees interested in annuity type option as the risk of longevity arises or outliving your assets. I think another one we see is sort of a guaranteed minimum payment benefit, in which as money's going in, a minimum payment coming out is guaranteed, in effect insured, so that employees are protected more against the downside risk of the investments.
And Barb, does it make sense to encourage employees to remain in the plan at retirement?
I think there's a lot of benefits for employees to stay in the plan. Now, a plan sponsor needs to choose if this is something they want to promote, but I think when you think from an employee perspective, it's a plan. It does have the fiduciary looking after it. So from that perspective, employees have that added protection and don't have to go search through that confusing retail marketplace where you aren't going to trust everyone.
And to the extent that a plan sponsor is focused on keeping people in the plan at retirement, what does that do to the communication or the communication challenges they may face?
I think that does add another consideration. We so often with communication focus on those active employees. As you start having more inactives in the plan, and many people already have this, it's focusing and making sure you've got communication in place that supports what your inactives may need to know about the investments and how they choose within the plan.
So as you look forward, what types of retirement income solutions are most likely to gain the greatest traction?
Yeah, it's hard to predict with that crystal ball what's going to happen. I do think we'll see a couple things though. One, we will see more employees looking for annuity type options. I really feel that employees are more sensitive to this risk of outliving their assets. So I think that's going to gain in popularity. If we actually look at what may get built into the plan, where we might see more traction is some of these guaranteed minimums. That's because it gives some protection that employers are looking for, especially as they're looking at the asset accumulation. Another thing we may see though, these options are really tough choices. Again, we're putting tough choices in front of the employees. We may see more embedded in things like your custom target strategies.
So Chris, what's your view on the retirement income solutions that are in the market today?
Well, I think the first thing we have to do, Stacy, with respect to the solutions that are in place today is recognize that a lot of the structures and a lot of the designs have been present in the individual side or the retail side of the investment and insurance marketplace for in some cases, decades. In particular, with respect to the corporate defined contribution plan environment, many of these concepts are brand new, and people who are providing them are working through the nascent issues of how do we deal with things like portability, complete participant experience, and things of that nature. So with that as a background, I'd say my view today is that of the many designs that are out there, the ones that are enjoying the greatest amount of uptake are the Guaranteed Living Withdrawal Benefit designs, or the GLWB designs. The second element that appears to be enjoying some take-up is the investment-only structure. So where you're using a combination of bonds or other fixed income and tips to create the income stream, but without necessarily the lifetime guarantee. I think the third type of design that we see a lot of interest around but yet no uptake is the hybrid design, where there's an integration of the investment strategy with the insurance elements, and the insurance elements aren't necessarily externally visible to the participants or the plan sponsors. So there's a great deal of design interest around those elements, but to date, no take-up. Unfortunately, the vehicle that is near and dear to many of the people in the insurance industry that we see as being financially efficient is the fixed annuity design, but there I think we see that the credit issues, the credit default issues are somewhat curtailing the take-up of that, in particular given the recent events in the market.
What needs to happen to bring more retirement income solutions, particularly the insurance, into plans?
Well, I think, Stacy, from our perspective, we see the need for three things to occur before acceptance becomes more widespread. The first is going to be a clean and clear way to address the single-party insurer risk that many people are concerned about today. The second, we believe, is a standardization amongst the designs. Today, there are a variety of designs, all with their own nuances, which makes it extremely complicated for plan sponsors and their consultants to understand. The second is, along with that standardization, there will become standardization along record keeping, other administrative practices, participant education, participant tools. All of these things we believe are necessary to accelerate the adoption for the insured vehicles.
So in working with a plan sponsor, if you were to suggest what they may want to do to help their participants in the retirement income side, whether with insurance or without, what are some of the things that you might suggest that they think about?
Well, I think for the plan sponsors, I would at least have them think about two things. One is on the education side. Make sure that they provide some materials to their participants to help them understand the risks that they're going to face. In particular, the ones that they might not be familiar with as they prepare for and enter retirement. So the risks around the timing of their retirement, the impact the volatility might have on their outcomes, and how they might generate retirement income. So as a participant, most people focus their energies on their job. They don't focus their energies on their financial plan or their retirement plan or how they're going to generate retirement income. So a plan sponsor can provide a great deal of benefit to their participants by giving them the education, the knowledge to understand what it is they're going to face. I think the other thing to keep in mind for the plan sponsor, the second item, is to then obviously consider options that would allow the participants to make use of an institutional option that may have been vetted through a sound fiduciary process or would have been vetted through a sound fiduciary process that would then enable the participants to take advantage of all the education that they've been provided. So whether that is an investment-based replacement income fund type of vehicle, or whether it's an insurance-oriented vehicle, I think a sponsor providing availability of an option like that to a plan participant would be beneficial.
And what about staying in the plan?
From the perspective of the participant, I think there's clearly benefits to staying in the plan. You'll have an institutionally priced product. You'll have the comfort or the benefit of knowing that a vetting process, a fiduciary process has been applied to select the products, and therefore the providers of those vehicles will likely be present during the time when you need them the most. And then I think from the institution's perspective or the plan sponsor's perspective, there's also the potential benefit that it may lower investment expenses related to the plan. So there's at least two aspects there from that perspective.
So a benefit both to the participant as well as to the plan.
Correct. We believe so, yes.
Great.